Up next, we have TEGNA. The company's headquartered in Tysons, Virginia, and owns and operates 64 television stations in 51 U.S. markets. TEGNA is the largest owner of Big Four network affiliates in the top 25 markets among independent station groups, reaching roughly 39% of all television households nationwide. In addition to its broadcast presence, TEGNA connects with over 100 million people monthly through its digital platforms, including web, mobile apps, streaming services, and over-the-top platforms. The company has about 160 million shares, trading around 1630 for a 2.6 billion equity market cap, 2.4 billion of net debt for a 5 billion total enterprise value. We have TEGNA's CFO, Julie Heskett, here with us today. Thanks so much for joining us.
Hello, good afternoon, everyone. Hi, Heina.
It's great to have you in person this year. You've been with us for a few years now, but first time, I think, meeting here in person. So, starting off higher level, as a leading pure play broadcaster, how does TEGNA see the longer term role of broadcast TV evolving in an increasingly streaming centric world? We've heard a lot about platform fragmentation. Does that strengthen the case for local linear reach, or does it increase pressure on pricing and scale?
So first I would just emphasize that entire ecosystem is around local and the emphasis on winning local. And the unmet need of consumers for local news, local sports, community reporting, and the unsaid reach that obviously broadcast has. You just mentioned 100 million people across all of our platforms at a given time. Those are the things that will benefit this fragmented streaming digital universe that is all unfolding in front of us as we speak. But we see some of that frustration from a consumer perspective, especially where to find certain programmings, and where that is actually strengthening broadcast and probably the cable bundles. You know, bundles have been successful for years. There was moving away from that. Now it's coming back. I think that will benefit. That's all favorable. But I also want to emphasize the strategic importance of, winning linear, but investing aggressively in digital platforms and meeting consumers where they are.
Great, and we'll talk more about that in a little bit as well. But I was hoping we could start with core advertising. You're in 51 markets, many of which are politically and economically significant. How does that geographic mix shape your advertising performance versus peers, and what are you seeing so far in terms of core ads in 2025?
Yeah, so first I think the portfolio is important. You're right. We have a lot of scale. Our portfolio is focused on Big Four, so that tends to also be favorable compared to some of our peers. We don't have as many non-Big Four or non-Big Six assets. And we are focused in large growing markets. So when you think about, Phoenix, Dallas, Houston, Atlanta, Denver, Seattle, like the bigger markets are where, again, the growth opportunity lies. So I think between being Big Four and large growing populations separates us from a portfolio perspective. As far as advertising, also I would say our diversification across the country, right? We're in the Northeast, we're in the Southeast, we're in the West, we're in mountains, we're Midwest. So we have some stability when it comes to macroeconomic. It's not any one region that is going to have a significant risk. So it's really more about the macro advertising. U.S. advertising economy is very mixed signals right now. Consumer sentiment is declining, but yet we didn't see a lot of that in first quarter. I think we had a pretty good first quarter advertising read, where first quarter advertising was down single digits, but it was really because of a tentpole event with Super Bowl and the different affiliations. If you normalized for that, our advertising dollars were actually flat, which I think was a really good read compared to our peers. Several different reasons for that, but that's not holding up in Q2. We are seeing softer across the board advertising in Q2, but not substantially. But it will be weaker in Q2, which could be a sentiment of the tariffs. It's really hard to get our hands if it is tariff related or I've heard and we've seen automotive for us is actually, strong relative. So not sure if people are moving money up, waiting, but I definitely think it's a cautionary environment that is impacting advertising.
Can you touch on drivers of the performance that you saw in Q1, and then also what you think is driving the trends that you're seeing on the auto side for TEGNA?
Yeah, so if you break down advertising into categories, I'll move there first. Services is our largest category, and services has been strong continuously quarter after quarter after quarter. It was strong in first quarter, it is very strong in second quarter. Auto, which is our second largest category, is actually holding up. It's flattish, maybe down slightly, but not down double digits, which is what we've seen for the last couple of years. So I don't know if it's a rebounding or a bottoming out, but auto is strong for us, and I think that is different across our peers. Other categories that are really strong for us are banking and financial services, as well as healthcare. Retail has been strong in the first half of this year, which we have not seen either. So that's, again, this mixed feeling with consumer sentiments. If you think about tariffs, a lot of those are not impacted by tariffs. Services, home services, legal services, real estate services are not necessarily impacted. And like I said, that's our largest category. Categories that are weaker for us are restaurants, entertainment, legalized sports betting, media telecom, type of categories.
Since you do have a presence in larger markets, Big Four areas, can you just touch on what you're seeing specifically in terms of local versus national, and how your sales strategy differs across these different types of advertisers?
Sure. So local, the majority of all of our revenue comes from local, approximately 65% versus national. And from a local perspective, really national, our go-to-market strategy is all platforms, bundle sales, whether it's linear, digital products, all of the businesses that we have. On the national sales, it's mostly, group sales, and we have the reach across the country. We can tap into the unwired networks from network advertisers as well. Sponsorships are another advantage. And local has held up much better than national. National has been down for quite some time, but local has never been down until this year, and it's down just slightly, very low single digits.
That's helpful. Moving on to some dynamics impacting the marketplace overall, in light of the new administration and FCC, there's been a renewed discussion about updating ownership rules and relaxing restrictions. What changes would be most impactful to TEGNA's strategy moving forward?
So we are enthusiastic about the attention that the FCC is giving to changing broadcasters' regulation. It's about time. So there's multiple different areas. The two that would benefit all of us from a synergy perspective in creating the most value, we believe, is in-market consolidation and then also raising of the cap.
Mm-hmm. What is your appetite for strategic acquisitions or divestitures? Would TEGNA consider a transformational deal again, like the Standard General transaction, which fell through back in 2023?
Well, first and foremost, I would just say we're all about creating shareholder value. Mm-hmm. So are we interested in all of that? Yes. From a size of transaction, I really like our position, right? The strength of our financial balance sheet, we have optionality, and I see whatever the deal is that comes that creates the most value is what we're going to entertain. I've been with the company a really long time. For 10 years, we were acquirers. We've doubled the size of our company, had tremendous growth from a shareholder perspective, being an acquirer. Then, yes, you just mentioned Standard General. There was a deal that was brought to us. We did our fiduciary responsibility. We looked at that as creating value. The deal did not go through, unfortunately. So I get it. Are you a buyer? Are you a seller? We can be either because we have optionality, but we're all about creating value.
That's helpful. What should investors be focused on in terms of major developments, and how should we be thinking about the time frame for anything to realistically occur?
On a regulatory perspective?
Yeah, and then consolidation from there, I guess.
Yeah, so again, I get new information every single day, right? This week with the latest Symington stepping down from the FCC. I believe that Brendan Carr, when he has the majority, will move very quickly and do regulatory relief. The time frame is just realistically probably 12 to 18 months once he has that majority. So the majority was going to come with the departure of Sparks, which was supposed to be Starks at the end of this month. And don't forget, we have Olivia Trusty, who will be confirmed soon after June. So it's just a moment of time. And I understand Symington this week just announced that he's going to leave too. So the timing of all this, you could be left with 2 FCC. You have to have 3 for a quorum. So now we just need Olivia Trusty to get confirmed, which again should happen soon after June.
Great. And then moving along to retransmission, can you remind us of your upcoming renewals on the distribution and then the network side as well as the cadence moving forward? How are you approaching upcoming renewals, and do you see a shift in leverage or dynamics between distributors, networks, and you guys?
Yeah, so from a portfolio perspective, we had about 45% of our subscribers, so top line MVPD renewals this year, 45%. We just completed 10% at the end of the first quarter. The rest of all of that will be at the end of the year, so will impact the future. From a network perspective, most of our deals are long-term deals. Our smallest affiliation, which is Fox, is up here in the end of June. It's about 7% of our portfolio. All the others, the 93%, is locked up through the end of 2026, early 2027, and even into 2028.
And can you just touch on kind of any shifts in leverage you're seeing in those negotiations from prior negotiations, or what you anticipate moving forward at all?
I can tell you from an affiliation perspective, I think we were one of the first to bend the curve of the growth on reverse comp. Last year when we negotiated the 2 of our deals. So I think the ecosystem is shifting more favorable to broadcasters. Obviously, the top line, because of sub declines, is more about subscribers, less about rates. Mm-hmm. So we continue to get growth in rates upon renewals and escalators.
How are you thinking about the trajectory of subscribers and declines there moving forward?
Yeah, so subscribers continue to be down low, mid-single digits. That's been pretty much the case for over a year now, that mid-single. There is seasonality, so there's certain quarters where it might be -4, and then there's certain quarters it's -7. Obviously, around sports in the winter months, it's lower, and in the summer months, it is higher. We are starting to see a slight change in pattern, but it's too early. We get our information typically 90 days in arrears from all of the distributors. I do think some of the traditional MVPDs are slowing down from an accelerated decline, so that is really good. You've probably seen it in Spectrum's, notes in that they're starting to see that. I might have 1 month of data on that, so I would like to see a few more if that's going to be a trend. But I would tell you on the virtual side, which still continues to grow, but the growth on the virtual side has slowed. And I think that there's a story there as well in the stickiness of the virtual versus broadcast. And again, it just reinforces the importance of these skinny bundles, which is why we're starting to see potential improvement on the traditional MVPD side.
That makes sense. So you anticipate continued shift towards skinny bundles, and that should help the ecosystem moving forward?
We are favorable for those.
Great. We just had a sports panel where broadcast was called out specifically in a few of the responses to questions. Can you talk a little bit about how TEGNA is participating in the sports landscape and those sort of opportunities?
Yeah, absolutely. I probably should have mentioned that on the advertising side too. Sports is a positive to the ecosystem, and it definitely benefits, broadcast, but mostly it benefits our audience. We're a local community business. and the local fan base is super impressive. And I think having local sports rights on broadcast has increased the audience for the teams anywhere from 2 times to 6 times, depending on the team. We have invested in sports. We take a disciplined approach. I would not say that we have a sports strategy. Sports games are programming, right? We're all about programming and we're about distribution, but we are about localism. But if you can improve your content, improve your programming, that's going to improve audience. And sports is definitely one of those things. Every survey that we do with consumer research on why you tune in to any of our products, they say number one, local news, and number two, sports, and we have both. So sports is just a positive ecosystem, but we're disciplined. We take the rights if it all pencils out. Our deals are profitable, but we've walked away from some as well. So we take a disciplined approach, but we love having them.
Great. So we've covered a lot of the opportunities for the company on the revenue side. There's a few more, but can you just touch on the cost side of the business? Any areas where you can look for further expense saving from here, and kind of what you've done to date as well on the cost structure?
Yeah, so we've been public with a target of reducing our core structure of $90 to $100 million. We're on track to hit that. That's an annual run rate as we exit 2025. It was a 2-year goal. And again, coming out of that failed merger agreement in 2023, we were on pause for quite a few years, unfortunately, with that deal. So we did have costs that needed to come out. So that was kind of the first tranche. Is there more? Possibly. But that was a pretty aggressive, goal to start with. I do want to emphasize we are investing at the same time. This is not just a cost takeout target. This is really about changing a, culture to zero waste, zero basing every dollar we spend. And the more we can save, the more we can invest. And we are investing, and we've got kind of 4 really key areas of focus that we want to reinvest in. A-plus talent, really changing with our new leadership and what Mike has brought, a sense of urgency and performance execution, but bringing in really good A talent and rigorous performance management. B, winning in digital and really investing in consumer products and improving that side of the equation, as well as shared resources and technology, automation, AI, recreating stations of the future with smaller footprint from a real estate perspective, but also bringing down our cost of capital. Like, it's endless. But my point is, we're only going to spend money what we have to spend money on. It's not a cost-taking effort, but we're going to use some of that money and reinvest.
That's helpful. So I guess diving in a little deeper to some of the commentary there, can you touch on the digital side of the business? And then I'll also be asking about Premion as well, kind of the outlook and opportunity for that business. So overall, the digital portfolio, kind of key highlights, and then we can dive into Premion a little bit deeper.
Yeah, so the digital side of equation, we have lots of different products, right? We have web solutions, we have web apps, we have mobile apps, we have streaming apps, we have CTV advertising company with Premion. We have Locked On podcasting and sports programming. Collectively, they're all growing. So from a digital perspective, that is the growth engine. On a local level, that is growing double digits. Our digital, local, and there is untapped opportunity. We have probably underperformed in selling digital audiences. We have the audiences, but we have not been able to, or we have not directly sold those. We're now turning all of that up. So that's part of that. On the national side, on digital, it is not growing as much. Again, net digital is growing, but national has declined for us, mostly on the Premion side of the business. And we can talk about that if you have another question.
Yeah, so I think we can dive into that a little bit more. I guess in terms of Premion, do you anticipate ways to possibly monetize or surface value for that business at some point down the road? Or I guess any other thoughts around your small businesses or investments that you've made?
Yeah, so Premion, for those of you who may not know, is our CTV advertising company, which we incubated, and it was a, organic growth engine in 2016, where we clearly saw the audience marketplace moving, right, to a CTV landscape. We wanted to be able to play and take those dollars. So we created Premion, which is ad insertion CTV company. Hugely successful. It is profitable, has always been profitable. Went from a zero to a, $200+ million, revenue within, 3 years. So that continues to be a growth. When you talk to our local advertisers as well as our local salespeople, they love the opportunity that we have that in our toolkit and that we can take it to market. What we needed to do was to grow that business from a technology perspective. So we bought Octillion, which is a DSP, to help support, but really to create better products to go to market with. That was a win-win acquisition because it benefited from a top line with new products, but also benefited from a cost perspective where we don't have to rely on a third party for our DSP, which we had to do before. So now it's just continuing to grow on the digital and CTV. TAM it's a great opportunity to be in.
And can you just touch on what happened with the national side of that business and pathway moving forward?
Yeah, so when we built Premion, it was all about local, and an unmet need for our local advertisers and consumers. But what happened is it was new. It was innovative at that time. So we had some large national agencies also come to us and say, "Oh, I want in. I want to do this." And so we did those, and they were large, at scale. Fast forward, and about 18 months ago, now you've got a much bigger, the trade desk, and you have more programmatic, and that is not the Premion sale, right? The Premion sale is local, white glove, extended reach, and all of those type of things that local advertisers don't have that capability to do themselves. So we've seen those national holding companies just move more towards trade desk and other solutions. So it's hurting our top line, but our local revenues just continue to grow.
That's helpful. And you highlighted before the company's industry-leading balance sheet, even after buying back a lot of stock after the Standard General deal was terminated. A lot of opportunities out there that we've touched on in terms of potential M&A, reinvesting in the business, other areas. Talk about your top capital allocation priorities and how you're thinking about uses of cash at this point.
Yeah, well, first, we remain committed to disciplined and strategic capital allocation, but our main focus is always shareholder return. So we publicly said that we would return 40 to 60% of our capital to shareholders. We're on target to do that. The remaining 40 to 60% would be all on investments of growth. M&A right now, when we came public with that was early in 2024 before any of this deregulation. But now that has created a real opportunity that we see in front of us, we've taken a more measured approach with share repurchases, not doing any in first quarter, probably waiting to see if we can maximize value through station M&A, which is what we've talked about here today. But if there's no deals to be had, if there's nothing, we will return that to shareholders. But that's our priorities at the moment.
That's helpful. And then you mentioned the AI opportunity is kind of an area where you're focusing. Can you talk about how you're using AI in the newsroom and the opportunity that you see there?
Yeah, absolutely. We are spending a lot of time on improving processes throughout the organization. And yes, the newsroom is one recipient of that, but not the only recipient of that. It's really all about making our journalists better and freeing up their time to be able to go out and do more stories. So we're building that from the ground up internally. And offshore resources, but we're piloting it in several stations now, and we hope to roll that out across the country soon.
What's the timeline on that?
Again, we're piloting it now, and it will be rolled out soon.
Great. I'm going to take a pause. A few audience questions. One in the back here.
Sure. Can you comment on the TV the TV Bureau's effort to get together a platform to make it easier for ad buyers to get access to your inventory? You know, in market with your peers, just so it's easier to do from a linear standpoint.
Yeah, so that I don't know about that specific one that you may be asking for, but again, I've been in the business a long time. We've needed this for a very long time. There's been many efforts around that, and I know even most recently efforts with Wide Orbit and Gateway and all of those things. I haven't seen it come to fruition at scale as of yet. But we applaud whatever efforts TVB is doing. The industry, we have to have it. We're too complicated from an advertising perspective, and we need more efficiencies and scales across all of the broadcast peers.
Any other audience questions, or I can continue? I guess in terms of kind of key opportunities or challenges that you see from where we sit today, anything that we haven't touched on specifically yet or that you'd like to highlight?
Let's see, we talked about sports.
Yeah.
I think you hit it all. Oh, one thing I did want to mention, I don't know if it was in the ecosystem or not, but back to reverse comp, because the FCC made a comment about holding reverse comp at 30%. So that was in the ecosystem. So I am getting a lot of questions from investors on that. So I don't know if it's on your mind, but I didn't mention it as of yet. That is favorable dialogue, and I love that it is in the ecosystem. And I just want to reinforce the conversations that the FCC is having is only beneficial to broadcasters. With that said, am I changing my forecast to assume that there's going to be a 30% cap on reverse comp? I am not. But I do believe that it's just another sign of this administration really changing the power between local broadcast and networks, national networks, and the importance of the trusted local businesses and the sustainability of local news.
Mm-hmm. That's helpful. And then just kind of as a closing comment, I mean, any thoughts on what you think investors are misunderstanding about TEGNA and the stock today? I mean, what else would you highlight for investors?
Yeah, so two things. First, I think broadcasting is so much more resilient than I think investors or a lot of people give us credit for. There's changes in the ecosystem, but the strengths and our assets of, again, the power of local news, sports, community, reach, the ability to have content that is not available on all of the digital platforms, but will be in the near future, I think is really exciting. And then I would be remiss if I didn't just say the change at TEGNA of we are going through a transformation period. The addition of Mike Stibe as CEO and the executives that he has brought on staff to help transform the business from an execution perspective, from a performance perspective, from a consumer perspective, from a digital growth perspective. The sense of urgency at TEGNA is very good. And so I like that, again, as a potential success for the company.
Great. Well, thank you so much for your time. We really appreciate it, and we look forward to having you back again next year.
Well, we thank you, Gabelli, also for all of your support.
Thanks.
Chris Morangi is a co-CIO, and Sergey Glazewski, Hannah Howard, and Justin McAuliffe are portfolio managers Gabelli Funds. This podcast is an excerpt from Gabelli Fund's 17th Annual Media and Entertainment Symposium. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of March 31st, 2025, affiliates of GAMCO Investors Incorporated beneficially own on behalf of their investment advisory clients or otherwise approximately 31.43% of Atlanta Braves Class A, 6.32% of Class C, 11.32% of Sinclair, 5.41% of EW Scripps, 2.67% of Gray Media Class A and less than 1% of Common, 2.41% of TEGNA, 2.25% of Ryman Hospitality, and less than 1% of all other companies mentioned. The analyst's views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other GAMCO officers, analysts, other employees, or of the firm as a whole. Because the investment personnel at Gamco and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain Gamco personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic, and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800-GABELLI 800-422-3554-914, 921-5100 fax, 914-921-5118 info@gabelli.com.